Mr. Speaker, while the strengthening of our anti-money laundering laws is welcome, the recent $3 billion money laundering case is a good reminder that we have to tackle money laundering comprehensively, and I will speak on this today. Like my Aljunied GRC colleague Sylvia Lim, I support the bill's objectives. However, we cannot just react to the immediate circumstances of money laundering cases, but need to more holistically address structural problems at their root to prevent ourselves from being caught out on the back foot. It would also prevent a situation where our legislation and regulations, which take time, end up having to constantly play catch-up to outlaw new ways in which criminals evolve to launder illicit funds. The challenge of money laundering that we face has several key facets. First, money laundering can originate from any area within financialized assets, including single-family offices, cryptocurrencies, fine art, and real estate. Second, we would be best served by a comprehensive Omnibus AML bill that consolidates and streamlines the various existing regulations, including the CFT, CDSA, and MAS guidelines. This unified approach should cover all relevant sectors, including financial institutions to dealers in precious metals. These laws should also be easily understood by all Singaporeans, not just specialized legal and compliance experts. An Omnibus bill would present an opportunity to future-proof our legislation by introducing a unifying principle of a duty of financial transparency for intermediaries, which does not require suspicion of a predicate offence and ensures that Singapore does not become a place that facilitates obfuscation of funds. Third, to effect real change, we must alter the incentive structures to foster a culture of vigilance throughout the financial industry, and we should act decisively to establish a whistleblowing fund. First, individual verticals. Mr. Speaker, money laundering is an issue that can only be effectively combated by addressing multiple potential entry points to maintain the integrity of our overall financial system. Given the rapid pace of financial innovation and the increasing complexity of corporate structures, we cannot realistically stay ahead of all asset classes unless we legislate proactively. I will focus on three areas not covered by the bill: single-family offices, SFOs, cryptocurrencies, and fine art. I hope that there can be discussion about the government's assessment of the risks in these sectors. It will be insufficient to merely state that these areas are not covered by the bill. We must understand how the government intends to address these areas and ensure that any gaps are effectively closed. Mr. Speaker, the 2021 collapse of Archegos Capital Management, a US $20 billion single-family office, highlights a critical regulatory overlap between AML concerns and systemic risk. Archegos used equity total return swaps to build US $100 billion of portfolio exposure while avoiding disclosure requirements, exposing a significant gap in financial oversight. In response, the US is contemplating significant regulatory changes. These include bringing family offices under the Investment Advisors Act, mandating ownership and business structure disclosures, and enhancing trade reporting under the Securities Exchange Act. Such measures could compel SFOs to provide detailed information about their trades and portfolios. I strongly advocate for similar advanced disclosure requirements for SFOs in Singapore. This approach would not only bolster our AML defences, but also curb potential market abuses by SFOs. We can hit two targets with a single type of policy instrument. For single-family offices, SFOs, recent events have demonstrated that SFOs can be a significant conduit for illicit funds entering Singapore. In July 2024, Deputy Prime Minister Gan Kim Yong revealed that 6 SFOs awarded tax incentives were linked to individuals convicted in the recent money laundering case. The number of family offices in Singapore has grown by nearly 200%, from 400 in 2020 to about 1,100 by the end of 2022. This rapid expansion increases the risk of importing financial crimes from jurisdictions with weaker AML controls. This is a live vulnerability in our AML framework. The current regulatory landscape presents a glaring gap. SFOs are exempt from MAS legislation or licensing requirements under the SFA, as they do not handle third-party funds. While this is an MHA bill, cooperation with MAS is key to addressing the risks. What then is the current status of the MAS public consultation on strengthening defences against money laundering risk in SFOs, launched on July 31st, 2023? The consultation proposed that all SFOs maintain a relationship with an MAS-regulated financial institution for AML checks. We have not seen any public updates on actions taken. If this public consultation has not been operationalized, then, as stated by MOS Alvin Tan in Parliament on 3rd October 2023, only SFOs applying for MAS tax incentives are subject to due diligence checks. This means SFOs not seeking tax incentives remain outside our AML framework. How do we justify this discrepancy? MAS Managing Director, Mr. Chia De-jun, stated on 18th July 2024 that Singapore had already issued a set of enhancements for SFOs last year. Can we get more clarity on this statement? Is this an operationalization of the July 2023 public consultation? To close the current regulatory gap, I suggest requiring all SFOs, regardless of tax incentive status, to register with and be licensed by MAS. Mr. Speaker, there's a related issue of remittance companies working with SFOs. Currently, SFOs are exempt from many due diligence requirements, allowing their transactions with remittance companies to go largely unscrutinized. Since 2019, MAS regulations have not required remittance houses to seek prior approval for new customers without face-to-face meetings. Are remittance houses now included in the April 2024 MAS Notice PSN 01? If not, what strengthening of remittance house diligence can we expect? I propose 2 immediate measures for remittance companies. First, to introduce cumulative transaction limits for SFOs receiving funds through remittance houses with an automated system to flag transactions exceeding those limits. Second, reinstate mandatory face-to-face verification for new customers, especially for high-value or frequent transactions involving SFOs. I will move on to cryptocurrencies. Cryptocurrencies and other digital assets present unique challenges to our anti-money AML efforts. Recent data indicates rising illicit fund flows. Chainalysis reports nearly $100 billion has been sent from known illicit wallets to conversion services since 2019, peaking at $30 billion in 2022. Crypto is increasingly used to launder proceeds from off-chain crimes like drug trafficking and fraud, not just crypto-specific crimes. In 2022 alone, the FBI reported that US victims lost $2.6 billion to pig butchering and other crypto fraud, with the true scale of losses unknown, as victims are often too embarrassed to report crimes to authorities. There is great technical complexity involved. While blockchains offer transparency, sophisticated laundering techniques involving multiple transactions and intermediaries pose tracing challenges. Both centralized exchanges with consolidated wallets and decentralized protocols enable the commingling of illicit and legitimate funds. This can take the form of consolidated exchange hot wallets for exchanges such as Binance, but also decentralized comminglement protocols through crypto tumblers such as Tornado Cash, or core protocol features such as Privacy Coin's Monero's ring signatures. There is a fundamental tension between crypto's desire for instant, irreversible transactions and the need for financial safeguards. While instant transaction finality is desirable in crypto for censorship resistance, it poses risks when it butts up against traditional finance. Our priority must be preserving Singapore's reputation for clean finance over accommodating crypto's preference for irreversibility. To address these concerns, we should consider methods like increasing off-ramp friction. Solutions could include enhancing scrutiny on crypto-to-fiat conversions, including 1 to 3 day escrow periods for large transactions, with the time bought to perform on-chain analysis through providers like Chainalysis to check for commingled funds or suspicious sources, both on centralized exchanges and decentralized protocols. Finally, I will move on to art. The art market, with its high-value transactions and potential for anonymity, has recently become an attractive avenue for those seeking to launder illicit funds. The 1MDB scandal provides a stark example of how the art market can be exploited. From May to September 2013, approximately $137 million from an account controlled by Joe Low's associates was used to purchase art at Christie's auctions. This includes Jean-Michel Basquiat's dust heads for $48.8 million, along with significant works by Alexander Calder and Mark Rothko. Lowe further leveraged these assets using 17 artworks to collateralize loans worth $107 million from Sotheby's, effectively creating additional layers of transactions to obscure the origins of the stolen funds. The scale of this issue is significant and growing with the depth of the market. In early 2023, China saw a 14% year-on-year increase in art auction sales to $7.9 billion, with the Old Masters segment alone rising 15% to $1.1 billion. Globally, the art-secured lending market has expanded rapidly, with Sotheby's Financial Services alone originating more than $10 billion in loans since its inception. The entire global art-secured lending space was valued at up to $34 billion in 2023. This growth in art-related financial services presents new challenges for anti-money laundering efforts. Collateralized portfolios of art can more easily obscure the origin of funds and complicate scrutiny of wealth sources. The US Treasury, recognizing these risks, recommended in a 2022 report that certain art market participants be subject to AML requirements, including suspicious activity reporting and KYC requirements. Given these developments, what steps is Singapore taking to address the risks of money laundering through the art market and other alternative assets? Are we considering implementing AML requirements for auction houses, galleries, and art-secured lenders operating in Singapore? Next, I will move on from individual markets to overarching considerations. Mr. Speaker, given the evolving nature of money laundering techniques, we should consider creating a single dedicated Omnibus AML legislation. This would consolidate the various amendments currently scattered across different acts, including the CFT, CDSA, and the numerous MAS guidelines. Such consolidation would encompass regulations for financial institutions, professionals, trustees, and dealers in precious metals. This omnibus approach serves two purposes. It simplifies compliance for industry professionals and makes our AML laws more accessible to the general public. Secondly, and more importantly, we should future-proof our legislation by introducing the unifying legal principle and being an affirmative duty of financial transparency. Currently, our laws require reporting of suspicious transactions when there are reasonable grounds to suspect criminal activity. I propose we go further. Financial institutions and gatekeepers should have an affirmative duty to ensure the transparency of all the transactions they facilitate. This new standard of care would require reasonable efforts to ensure transparency, which is more proactive than our current suspicion-based reporting. It would involve comprehensive origin and destination checks for funds, verification of the economic rationale for complex transaction structures, and enhanced ongoing monitoring for high-risk clients or transactions. The advantage of this approach is that it does not require suspicion of a predicate offense. Instead, it ensures that Singapore does not become a place that facilitates the obfuscation of funds, which some call Singapore washing. We can protect private wealth without enabling financial opacity. This approach allows us to target the core issue of financial opacity, adapting to new financial instruments and practices as they emerge. It positions Singapore as a leader in combating global money laundering while maintaining our attractiveness as a financial hub. Finally, Mr. Speaker, in response to the clear need to shift the culture among our financial gatekeepers, we can approach it from a different angle. Rather than viewing AML measures as mere administrative burdens, we must foster an environment where vigilance is valued and rewarded. In our fight against money laundering, we must recognize the crucial role of whistleblowers and create a system that incentivizes proactive reporting and cooperation. I propose that we allocate a portion of the assets confiscated from money launderers to establish a whistleblowing fund. This fund would serve to reward those who come forward with valuable information, with the size of the awards proportional to the value of the assets seized as a result of their disclosures. The United States offers an instructive model. In 2023, the US enacted the Anti-Money Laundering Whistleblower Improvement Act as part of the Consolidated Appropriations Act 2023. This legislation, passed unanimously by the Senate, significantly enhances incentives for whistleblowers. Key provisions include, first, guaranteed awards of 10 to 30% of the financial fines collected for qualified whistleblowers. Second, establishment of a $300 million financial integrity fund funded by criminal forfeitures, fines, and victim restitution. Third, expansion of eligibility to include non-US citizens, corporate auditors, and compliance professionals. The US experience offers valuable lessons for crafting an effective whistleblower campaign. Mandatory awards are crucial. Discretionary awards are rarely paid and have proven ineffective in incentivizing whistleblowers. Confidentiality and anonymity protections allowing whistleblowers to file complaints anonymously and maintain their anonymity encourage higher participation rates. Compensation for related actions where whistleblowers are rewarded for enforcement actions by all relevant agencies resulting from their tip promotes comprehensive reporting to all relevant authorities. For us in Singapore, the $3 billion money laundering case has indicated that there is somewhat of a culture of viewing self-reported checks as administrative hurdles to be avoided in pursuit of profits. This cultural issue needs addressing in any regulatory framework. I believe that a whistleblower fund, properly implemented, offers us the best shot of changing the game and mindset around suspicious transaction reporting. In the fight against money laundering, we will need both carrots and sticks. While the United States already has a strong AML framework, as evidenced by its prosecution of the 1MDB case, it still saw the need to enhance the whistleblower system. Singapore should follow suit, recognizing that motivating individuals to come forward is essential to maintaining a clean and transparent financial system. By implementing these measures, we can turn the current AML lapses into a catalyst for positive change, fostering a culture of integrity and vigilance within our financial sector. A whistleblower fund seeded from the ill-gotten gains of the Fujian money launderers could be the cornerstone of a cleaner, more transparent financial future for Singapore. Thank you.